Now let's talk about payroll liabilities. And payroll liabilities is one of the important parts of this chapter. So in accounting, payroll refers to the amount paid to employees for services they provide during the period. A company's payroll is important for many reasons. One of those reasons is that payroll and related payroll taxes significantly affect the net income of most companies. And you'll be surprised to see that salaries expense and wages expense represent a big percentage of many companies, like manufacturing companies, service companies. Even in schools, you can see like up to 80% of the budget only goes to payroll. Also, payroll is subject to federal and state regulations that must be followed. Good employees' morale require payroll to be paid timely and accurately. So I think one of the worst things for an employee is that at the end of the month, they don't receive their pay, or even they get a wrong pay. So that's one of those things that is very important for employees. Now let's cover the liabilities for employee earnings. So salary usually referred to payments for managerial and administrative services. On the other side, we have something called wages, and wages usually refer to payment for employees for employee manual labor. So going back to salary, salary is normally expressed in the term of a month or a year. On the other side, wages, they are normally stated on an hourly or a weekly basis. The salary or wage of an employee may be increased by bonuses, commissions, profit sharing, or cost of living adjustments. So all of these things can affect the salary or the wage. Companies engaged in interstate commerce must follow the Fair Labor Standards Act, and this act, sometimes called the Federal Wage and Hour Law, required employers to pay a minimum rate of 1.5 times the regular rate for all hours worked in excess of 40 hours per week. So if you have an employee who works, let's say, 50 hours at $10 per hour, so the first 40 hours would be based on $10, and then the remaining 10 hours to complete the 50 hours that worked during the week would be paid at the rate of $15, which is 1.5 the time of the regular pay. And it's a way to make sure that employers are not like abusing their employees. And if they ask them to work an extra hour, then this extra time is going to be compensated at a higher rate. So let's see this example. An employee's earnings assume that John T. McGrath is a salesperson employed by McDormand Supply Company. McGrath's regular rate is $34 per hour, and any hours worked in excess of the 40 hours are paid at 1.5 times the regular rate. McGrath worked 42 hours for the week ended December 27th. His earnings for the week would be computed as follows. You can see that the earnings at regular rate, which is the first 40 hours at 34, and that would be $13.60 simply by multiplying 40 by 34. And then remember that he worked 42 hours, so he has 2 hours that should be based on the extra rate. So the earnings at the overtime rate would be 2 hours, which is the excess over the 40 to reach the 42, multiplied by 34, multiplied by 1.5 or 1.5, and that would be $102. Add these together, the total earnings would be $14.62. So let's see the deductions from employees' earnings. And we all get our paycheck, and when we look at the paycheck, we find that there are a few things that get deducted from the paycheck. So the total earnings of an employee for a payroll period, including any overtime pay, are called the gross pay. Unfortunately, we never get the gross pay. We have to get some deductions, and what we receive at the very end, we get the net pay. So from this amount is subtracted one or more deductions to arrive at the net pay. Net pay is the amount paid the employees. The deductions normally include the following, like federal income tax, state income tax, local income tax, if the city where you live takes local income tax, medical insurance, pension contributions, and it could be some others deductions that can be also deducted from your gross pay to reach the net pay. In regards to income taxes, employers normally withhold a portion of employee earnings for payment of the employee's federal income tax. So instead of giving you all your money or all your pay at the end of the month or end of the week or sometimes people get paid bi-weekly. So when you get your paycheck, usually the employer would withhold part of your earnings for payments of employees' federal income tax. Each employee authorized the amount to be withheld by completing a form called W-4. And don't confuse the W-4 with the W-2. The W-2 form is the one that we use to prepare our tax return, which shows how much money we made and how much was already withheld. But the W-4, it's an authorization for the employee, for the employer, I mean, to withhold the amount of taxes in advance. So this is how the W-4 form would look like. You can see that it has the name of the employee, their social security number, their address, and one of the important things is here, question number 5, or section number 5 here, where it says total number of allowances you're claiming. And in this case, if you are single, usually put 1. If someone who's married, they usually put 2. If they're married and let's say they have 2 kids, then the number of allowances would be 4. And again, it's your decision. And based on this number, the employer would deduct or withhold part of your pay to be paid for taxes in advance. So the smaller the number, the larger the amount that's going to be withheld. And the larger the number, the smaller the amount that's going to be withheld. And then you can see that the employee here would sign and date, because this is like a form of authorizing the employer to withhold this kind of taxes. So on the W-4, an employee indicates marital status and the number of withholding allowances. A single employee may claim 1 withholding allowance. A married employee may claim an additional allowance for a spouse. An employee may also claim an allowance for each dependent other than a spouse. And there could be different forms of dependent. It doesn't have to be just the kids. So each allowance reduces the federal income tax withheld from the employee's pay. The federal income tax withheld depends on each employee's gross pay and the W-4 allowance. Withholding tables issued by the IRS are used to determine amounts to withhold. I think going into these tables is beyond the interest of our course here, but in a payroll course, an accounting payroll course, I think this is something that is typically covered. I'm sure you heard about something called FICA or FICA Tax, and the FICA Tax, it's short for the Federal Insurance Contribution Act tax. So employers are required by FICA to withhold a portion of the earnings of each employee. The FICA tax withheld contributes to the following 2 federal programs. One of these programs is Social Security, and the other one is Medicare. So for Social Security, this provides payments for retirees, survivors, and disability insurance. Medicare, which provides health insurance for senior citizens. The amount withheld from each employee is based on the employee's earnings paid in the calendar year. The withholding tax rates and maximum earnings subject to tax are often revised by Congress. For simplicity reason, we're going to use these percentages, which are slightly different from what are used in real life. So we're going to use Social Security percentage as 6% on earnings, and Medicare would be 1.5% on earnings. So let's see this example. Assume that John T. McGrath earnings for the week ending December 27th are $1,462. Total FICA tax to be withheld is computed as follows. So we get the earnings subject to the 6% security tax. We get the $1,462 multiplied by 6%, and that would be $87.72, and that's the Social Security tax to be deducted from your paycheck. And then use the same number multiplied by 1.5% for Medicare, and that would be $21.93. Add them together, and that's your total FICA tax. Employees may choose also to have additional amounts deducted from their gross pay, such as deductions for retirement savings, charitable contributions, or life insurance. And these sometimes are optional deductions that the employer would offer for their employees. So how we compute the employee's net pay? So gross earnings less payroll deductions equal the net pay, and sometimes we call it the take-home pay. So in simple terms, we just see our gross earning, which is how much we have in our contract, less all these deductions, and the net pay would be what we call it, the take-home pay. So let's see an example for how this works. Assume that John T. McGrath authorized weekly deductions of $20 for retirement savings and $5 for a United Fund contribution, which is like a union. Assuming that $257.95 of federal income tax is withheld, McGrath net pay for the week ended would be computed for, or the week ended December 27th would be computed as follows. So here is his gross earnings for the week, $1,462, and then you can see the deductions where we have the Social Security tax to be $87, which we just calculated, Medicare tax $21.93. Both of these are called FICA, and in the next video when we go over the employer's payroll tax, I will see that the employer would actually match these two. So for every dollar paid by the employee, the employer pays the exact same amount for employer's payroll tax. So I hate to say this, but it's like the government is double dipping. So they're taking from the employee and from the employer the exact same amount for these FICA taxes. Then the federal income tax is $257.95, retirement savings $20, United Fund $5, and the total deduction would be $392.60, and the net pay, or what we call it, the take-home pay, would be $1,069.40. So let me stop here. In the next video, we'll start talking about the employer's payroll taxes.